coming out of the acquisition boom from 2020 to 2022, there is a very specific focus on post-earnout organic growth that the brokers who have acquired agencies are able to achieve.
Welcome to the Leader's Edge podcast. I'm Sandy Laycox, Editor-in-Chief of Leader's Edge. In this episode, I talk with Matthew Scally and Grier Dienstag from McKinsey. Matthew and Grier were among the authors on a recent piece of research, Investing in Insurance, the Value Imperative, which looks at recent investment trends in the industry. We sat down to discuss their findings. Our conversation begins with the overall investment landscape in 2024 and into 2025. We discuss the trends affecting private equity investment appetites and facilitating momentum in the investment landscape.
I would say, quite simply by volume and value, private equity leveraged buyouts were back in 2024. For some simple data points, the third quarter of 2024 saw the highest amount of leveraged buy volume since the first quarter of 2022, which is on the tail end of that boom. And private markets were 50% greater than public markets through the first 3 quarters of 2024. So the data is not fully locked. But we expect 2024 to be a really solid year in terms of capital allocated and deals facilitated. And that is, of course, a component of multiple different industries and a few different factors. One, we saw the rate environment stabilize a bit, and views that on a go-forward basis, there is going to be continued downward pressure on some of the interest rate costs and the cost of capital for these folks. Private equity, as most people well know, is an illiquid investment which requires deployment of capital. So you can go back to funds raised in 21 and 22 and 23, and there is still a need to deploy this dry powder. Yes, fundraising in 2022 and 2023 was a little compressed, but there is still a lot of dollars out there that need to be spent. I also think in 2024, there was a bit of a narrowing of the bid-ask spread between buyers and sellers. And that, I think, helped facilitate some of the transaction momentum we saw throughout 2024, but specifically in the back half as well. I will say, as private equity or leverage buyouts, or whatever term you want to use, continues to mature, there has been and will continue to be more and more of a focus on value creation and identifying the thesis as opposed to solely investing behind tailwinds in a specific market. How are we going to accomplish our EBITDA targets? What are our focuses in terms of adjacencies we can go into? What is our deployment strategy? How is technology going to allow this business to be more and more efficient? Are all points that we're having deeper conversations with our private equity clients.
We dig further into investment in the insurance industry specifically as Grier shares industry-specific trends and 2025 expectations.
So we saw similar trends in insurance that mirrored the overall private capital ecosystem. So as Matt mentioned, that spike in deal activity in 2021, a precipitous drop into 2022 and also 2023. And then the return of insurance investing in 2024 looked similar to the overall environment. If we break down what types of deals those included, it included some of the major brokerage deals, as well as a return for many large brokers to continuing to acquire smaller brokers. We also saw continued activity in MGAs, claim services, and technology, not to mention some of the balance sheet and permanent capital investing that continues to occur. Go forward, similar also to the overall outlook, we expect an increased deal activity in insurance in 2025. We're already seeing that in the first quarter, and know that there are both a number of assets that need to trade. They're nearing the end of their hold periods, 5, 7, 8 years in. And similarly, several investors who have either successfully raised or still have money to spend from prior funds. So we expect it to be a great year ahead for M&A.
We then get into a discussion of what really drives value in investors' eyes and how they are evaluating potential insurance industry investments.
First and foremost, we did see some level of depression in the valuations across the insurance space. And that, again, to Grier's point, mirrored what we saw more broadly in 22 and 23 with the broader leverage buyout space. Within brokers specifically, we've seen a bit of a bifurcation, and investors, particularly in the private space, really valuing a more centralized, technology-driven platform that have clear succession planning in place, clear thought processes and data related to the placement of the business, clear vision on where the growth is going to come from by geographies, by lines of business, as well as specifically by industries that they're trying to partner with. There has historically always been a focus on producer and client retention, and that remains. And I think coming out of the acquisition boom from 2020 to 2022, there is a very specific focus on post earnout organic growth that the brokers who have acquired agencies are able to achieve. And all of that ties together with a more centralized organic growth driven brokerage is getting valued at a materially higher multiple than the one that has remained more federated and might not have the same level of succession planning that's in place.
I would think that really does create a real, like you mentioned, a bifurcation among potential targets, because there does seem to be those aggregators who are very focused on then integration, and then the ones who just kind of have a lot of disparate small agencies.
I will say, to many management teams' credits, they have been focusing on these levers for the last few years. They have certainly not been blind to them. And I can think of a lot of our interactions with these leadership teams have been focused on those points: how to platform and how to integrate more effectively. What's our producer and client retention strategy? Where do we need to lean forward or on organic growth, i.e., new client lead generation sources? As well as services that we can offer, our end clients. So kudos to them for making that step, but I do feel the industry has a while to go. And to your point, Sandy, there is still a gulf between folks who are doing this, exceptionally well, and others that are maybe in their early innings of executing on this plan.
One aspect of the insurance value chain that has seen significant investor interest was MGAs. Grier and Matthew share what aspects of MGAs are drawing investor interests, who's buying MGAs, and external factors affecting their growth.
MGA has been the major investment theme over the last 3 or 4 years, and one that wasn't top of mind for most of our clients 5 or 6 years ago. If we think about some of the structural and cyclical changes that have driven the significant growth in MGA formation, especially immediately coming out of the pandemic, as well as premium shifting over to MGAs, we think about a few things. One, the shift in the nature of risk, more complex risk, more difficult to place. Some of these changes, like increased nat cat incidents, larger verdicts coming out of liability claims as two examples. And those structural changes combined with more cyclical changes like the rate environment as one example. Also thinking about the outflow of talent from carriers in particular, given some of these return to work mandates coming out of the pandemic. A lot of tailwinds for the MGA space. If we step back and say, what do investors care about? Where are we seeing the most interest? It's often in aggregated MGAs. So MGAs that are diversified from an exposure perspective, different lines of business, different geographies, different industry segment focuses. And that requires different expertise across each of those areas. It requires different distribution networks, but it also helps to have a variety of capacity providers that may be providing capacity to 2 completely different programs within that aggregated MGA, and be able to help with some of the downside risk if all of a sudden one of your programs would face a really challenged loss ratio environment in 1 year. If we step back and say, okay, there are only a few of those aggregated MGAs in the market. Overall, some of them might be for sale, some of them not necessarily, and that creates a lot of investor interest in those that might come to market. But it also creates another cohort of investors who say either we don't want to pay the multiples that those aggregated large MGAs might demand, or that's not going to be part of our investment strategy, and instead we're going to look to go back specific individuals, team lift outs, star talent from whether it be a carrier or another MGA, and help support them and eventually grow into an MGA that might have similar diversification that we've seen in some of the successful deals of the past few years.
Yeah, the other piece I'd add on the MGA portion of this discussion is it is a highly competitive transaction market. It is not just private equity investors who are looking to deploy capital in this space. Brokerages and management teams, as well as even other carriers, right, are looking to acquire, form, establish MGAs. And you have a material amount of talent that is, Grier mentioned, pulling out of that and looking to combine or either join those organizations. And we've seen a lot of success, though again, still in the early days, of brokers effectively managing and partnering with MGAs, either through, wholly acquiring them, taking an equity stake, or just be more thoughtful in that partnership loop. So it's an area that has a lot of attractive tailwinds, and investors across the ecosystem, not just private equity, have picked up on that.
Claims services is another area that has seen particular attention from investors recently. Grier breaks down that industry for us and investor trends.
I'm happy to. So claims has been a huge focus area coming out of the challenged loss ratio environment that many of our carrier clients saw in the early years of this decade. We've seen a huge focus on accuracy, in particular in claims that spans across lines of business, looking at some of the prior programs that might have driven down adjusting expense and saying we need to make sure that that's not at the expense, no pun intended, of worse accuracy. The number one priority is going to be paying out the claims as they deserve to be paid out, and ideally doing so in a way that also manages the very litigious environment in which we live, ensures that claimants are paid what they deserve quickly. And that as part of that, that means that there is a lot of opportunity for innovation. So that means bringing some of the learnings from the auto world over to property, which we still see being generally many years behind the auto claims environment, despite a lot of innovation there. Thinking through what does it mean to bring newer technologies like Gen AI as an example, to really create co-pilots for adjusters. And these trends I talk about in the context of carriers because they're so relevant to our investing clients or investor clients as well. And what I mean by that is to say there are a number of large-scale TPAs, both here in the United States as well as in Europe, that have very similar challenges and opportunities to carriers with large claims organizations looking to innovate, looking to bring the best solutions that they can at the best cost to their clients, whether they be self-insured or carriers themselves. And then similarly looking to say, we have a lot more opportunity now as it relates to the use of our data, as it relates to analytics, and what does it mean to really have a set of scaled solutions, whether that be sitting within a TPA or whether that be the long list of innovative players playing more of a point solution type role into the claims ecosystem and really driving significant value in pursuit of that accuracy I mentioned.
We move on to the changing external environment of risk and what that means for investors in the space.
Yeah, I personally feel from the conversations that I have with my clients that there is a move towards specialization and complex risk, and investors are excited to putting capital behind that, whether it's on the distribution side or whether it's on the underwriting and balance sheet component of this. We have more and more conversations around where rates are going to go in relation to E&S markets, how brokers and admitted markets are going to try and better serve or provide capacity, and if that's an opportunity or a risk. So I do see a flight to specialization happening, and the private equity investors that are out there that spend a lot of time in financial services or specifically in insurance are taking note of that and have been very active in and around that space.
Is there a tech component here? As obviously specialization, you hit the nail on the head there. Are they looking at companies or players that are utilizing advanced technology more as more beneficial, more value creation, or not?
They certainly are. And there's some specific examples of where that has been successful. Private equity investors are always going to gear themselves towards service and tech-oriented and tech-enabled businesses, especially, given the hot tailwinds, everything and anything related to AI or generative AI has performed. And the insurance industry is no different than others. There are opportunities from efficiency gains. There's opportunities from more accurate underwriting. There's opportunities to develop a better and stronger placement strategy if you're a distributor, all associated with technology support. And many of the AMS providers, the outsourced providers to the insurance distribution and balance sheet landscape are focused and thoughtful around this. And there's a reason why ITC is so well attended in Las Vegas. Everyone wants to understand what else is happening and what opportunities they may or may not be missing. That said, I do think there is a broader proof point for some of these solutions to actually show a real strong ROI. And investors are always going to be very weary of pre-revenue or light revenue businesses before they write very large multiples associated with it. I also have a thesis, and others probably agree, some may disagree, that where these capabilities are housed is not set. They're not necessarily always going to be independent companies who are servicing, whether it's the distribution ecosystem or the balance sheet. There is a lot of investment being made by distributors and by carriers on internally owning some of these capabilities too. So the world is going to have to find a nice balance between what folks want to develop internally from management teams' perspectives and versus what they want to outsource and want to be able to use best of breed in.
Finally, we discuss the future and the potential for a broker evolution to come.
We have gone through a cycle over the past 10 or 15 years of significant fears around disruptions. We talked about ITC and the importance of technology, and there was a world a decade ago where there was consistent conversation around the disruptors that would come in and take the place of an independent agent and push the majority of the market direct. There was up through commercial lines, to be clear, there was discussion about carriers no longer playing an important role in the ecosystem, given the rising role of brokers and the increased economic profit that they generate. I think what we've seen is that while there have been significant changes and value has shifted among peers from carrier to carrier, broker to broker, the dynamics of the industry are rather stable at this period in time. And there's nothing to suggest that we're going to see a massive change in the next 5 years from the concept of balance sheet players, carriers, whether they be legacy carriers that operate as mutuals or as publicly traded companies, or whether they be permanent capital backed players that are riding that trend with their private capital investors. We do see an important role for large, diversified capacity providers and carriers, and there will be winners and losers among that group, but they will exist. Similarly, we see that brokers are playing an ever important and in some ways increasingly important role in the ecosystem in the way that they're aggregating the business that they write, whether it be with their own owned MGAs, taking on more of that underwriting role, with their own wholesalers, trying to push more of that business through wholesalers, assuming everything is still the same from a client and coverage perspective. So I think what we would say is the macro forces of the industry are here to stay. And the question becomes, what separates the winners from the losers in each of those major categories, and who will be the service providers and solutions playing into that industry, whether it be in the claims space, whether it be in underwriting technology, whether it be in data and analytics, where there's significant money to be made from an M&A perspective.
Yeah. And I always default to the quote that someone said, which is, we always overestimate the amount and pace of change in the next 2 years, but underestimate it in a decade plus. And I think that's really relevant for the insurance industry today. I have no doubt a decade from now, there will be increased or even material different sources of risk appetite and capacity than what exists today. You, of course, already see elements of that, whether it's through ILSs, whether it's through parametric insurance, the continued growth in the excess and surplus markets. Third-party capital, is going to enter and continue to grow within this space. And I will say distributors in particular should and are going to need to be very thoughtful of how they want to develop those relationships to ensure that the placement of risk for their clients is best suited. The structure of it, the exclusionary criteria, and frankly, the overall cost of it. But over the next couple of years, the world probably won't move in that direction as fast as maybe some people believe.
It sounds like potentially there's huge wins out there for the clients as they benefit from all of this happening behind the scenes and, potentially better risk underwriting, right? More capacity, as you've mentioned, to better serve policyholders.
Yeah, I think the end of this is distributors are going to continue to get more and more sophisticated. That should, in thesis, flow back down to the insureds, meaning that they have better structure, better cost for that risk, and it's placed in a market or in part of an end ecosystem that is able to absorb it effectively. And I think our insurance, whether it's on the P&C or the EB side, is a critical part of how we do business, right? How our economy functions. And there's a lot of smart people making some pretty big bets in and around that area.
That was Matthew Scally and Grier Dienstag from McKinsey. I hope you enjoyed our conversation. For more Leaders Edge podcasts, go to leadersedge.com or subscribe to us on your preferred podcast platform.